Hi, I'm Sam Chandan, founder of Chandan Economics and the Silverstein Chair at the NYU SPS Schack Institute of Real Estate. The research team at Arbor and Chandan has just released its second quarter small multifamily investment trends report, which covers relatively smaller properties, typically buildings with mortgages between $1 and $7.5 million. Whether we're talking about smaller or larger properties, data from the National Multifamily Housing Council, NMHC, and its various data partners is pretty clear that professionally managed apartment buildings are performing well, the pandemic and job losses notwithstanding. In July, 95.7% of renters paid their rent in full or in part, down less than 1 percentage point from 96.6% in July 2019. The year-over-year comparison is a bit weaker for August, with 90% paying rent as of August 20th of this year, compared with 92.1% a year ago. This strength is not to say that the rental crisis that I and others have written about isn't a very real feature of the market. When we look at the most income-constrained renters, particularly in communities of color, we see that as many as one-third reported little or no confidence in making their next rent payment. One explanation for the difference between the NMHC reports and data from the census and others is limitations in the overlap in what each is tracking. The low-income families hardest hit by the pandemic and by job losses, who are at greatest risk of housing dislocation, often don't live in professionally managed properties, but they are real. So is the risk for their families, and so is the need for a policy response after the expiration of CARES Act protections last month. On balance, small multifamily properties are performing well. To be sure, prices and property income have declined, prices by 5.6% compared to a year ago. But as compared to some other property types, where prices and transaction volumes have suffered much steeper declines, small multifamily trends really underline the resilience of the sector in the face of a deep global health and economic crisis. On the lending side, there's been a shift to refinancing, reflecting a slowdown in new deal activity. That's to be expected. We've also tracked a significant decline in small multifamily loan-to-value ratios, which fell 360 basis points nationally during the second quarter. Again, some tightening of underwriting standards is to be expected given the larger uncertainties in the economy. Overall, our outlook for small multifamily is bullish. For several years now, the combined small property research program at Arbor and Chandan has focused as much on who lives in small properties, what attracts them to smaller properties, and what keeps them there, as much as cap rates and debt yields. When we look at the current shifts in demographics and household preferences favoring larger units and lower congestion, our baseline analysis shows we'll need more small properties in the coming years, not fewer, especially in support of workforce demand. That factors in that some of the changes in the way we live and work will revert to pre-pandemic norms at some point, and importantly, that some will persist, and were already forces in the market long before the crisis.